Hello everyone and welcome to our first video on the adjusting process in financial accounting. So the first thing we want to introduce is the difference between accrual accounting and the cash basis of accounting. So accrual accounting records the effects of each transaction as it occurs. So following the matching principle, it's going to disregard when expenses are paid. So we're going to be more interested in when expenses are incurred. So we're going to record expenses when they're incurred, not necessarily when paid. And it's going to disregard when revenues are received as opposed to when revenues are earned. So according to the revenue principle, we record revenues when they're earned, not necessarily when cash is received. Under the cash basis of accounting, we're really only interested in when cash is affected. So when cash receipts happen or when cash payments happen. So under the cash basis of accounting, we disregard when expenses are incurred. We only care about when expenses are paid. And we disregard when revenues are earned. We're only interested in when revenues are paid. So it's very important to distinguish the differences in these two types of accounting. So let's look at 5 adjusting entries or categories of adjusting entries. The first one is prepaid expenses. This is when there are advance payments of expenses. So this is when we pay them first and we expense them later. So let's look at an example. So let's say you prepay your rent of $600 on April the 1st. Your rent is $100 per month. So let's journalize the April the 1st entry to record the payment of rent in advance. So we really haven't gotten to the adjusting entry yet. We're just recording the payment of our rent in advance. So that would look like this. So we record a debit to our prepaid rent, which is an asset, of $600, and we paid it in cash. So cash is going down. Cash goes down with a credit. So we would credit cash for $600. Now on April the 30th, we have used up now 1 month of that prepaid rent. So we have to record the using up of this asset, this prepaid rent. So we would need to reduce our prepaid rent. So now we have to think about how that happens. So prepaid rent is an asset. So if it's going down, we're using it up, we would credit prepaid rent. Now we have to think about what is our debit. Well, we have used up an asset. The using up of an asset is an expense. In this case, it's rent expense. So this would be our journal entry. So we would debit rent expense for that $100 because each month our rent is $100. And we would credit prepaid rent because we're using up that asset. So now let's do another entry, the using up of rent in May. Well, we're using up another month of our prepaid rent. And we're using up of an asset, so we would again debit an expense, so the entry would look exactly the same the following month. Now let's move on to our second type of adjusting entry, and that is depreciation. Depreciation is the allocation of the cost of a long-term asset over its useful life. So let's say you purchase equipment for $18,000 on April the 1st. You estimate that the useful life of this equipment will be 5 years. So we're going to use the straight line method of depreciation. Straight line simply means we're going to allocate the cost of the asset equally over its useful life. So we're going to journalize the purchase of the equipment first, and then we'll journalize April's depreciation expense. Okay, so again, we're going to journalize the purchase. So we purchased a piece of equipment for $18,000. In cash. It doesn't say we did it on account or a note payable or anything like that. So we're purchasing it for cash. So cash is going down. Cash goes down with a credit. So cash is going to get credited. And we're purchasing a piece of equipment. And equipment is an asset, and we're getting an asset, so assets are increasing. So we would debit equipment for $18,000 and credit cash for $18,000. Now we need to figure out what our depreciation is per year using the straight line method. Okay, so we're going to spread the cost of our equipment, which was $18,000, equally over its useful life. And we believe the useful life of this asset is 5 years. So we'll take the cost of the asset, divide it by 5 years to get our yearly depreciation, which comes out to be $3,600 per year. But in this instance, we want it on a monthly basis. So we're going to have to divide the 3,600 by 12 to get $300 per month. So to record the depreciation at the end of April, we need to determine what that entry looks like. So when we're recording depreciation expense, we're going to debit what's called depreciation expense, which is an expense account, and we're going to credit accumulated depreciation. So keep in mind, accumulated depreciation is a contra asset account. So it carries a normal credit balance, but it's a contra asset. So it would still be found in the asset section of the balance sheet. It would follow this equipment. So what it effectively does is reduces the book value of the equipment. So even though the equipment stays on the books at $18,000, also on the balance sheet underneath equipment, we would see this accumulated depreciation account with a balance now of $300. So we would be able to calculate our net value of equipment. So the net value of our equipment would be only $17,700. But keep in mind that equipment stays on the balance sheet at $18,000. But now we would also see this accumulated depreciation account following it. Okay, so again, just to reiterate, remember the accumulated depreciation account is a contra asset. Even though it's reducing the asset balance, it's still listed on the balance sheet with the assets. Now let's look at our next type of adjusting entry, and that is accrued expenses. So an accrued expense is an expense that has been incurred, but it not yet been paid. So this always creates a liability. So you expense first and then you pay later. So let's give you an example here. So let's say you pay salaries on the 15th of every month. Your salaries per employee total $1,800 for the whole month. You have a new employee that began work on April the 1st. So we need to journalize the entries needed for the remainder of April and the entry required on May the 15th, if any, for this employee. So the first thing we do is this employee has now worked from April the 1st through April the 15th, because now remember, we pay on the 15th of the month. That's when we pay. So we owe this person half of their monthly salary because they've worked half a month. And we're also expensing that because we have now incurred that expense. So on April the 15th for this employee, we would debit salary expense for $900 and credit cash for $900 because we are paying them and we've expensed it or incurred that expense. But now what happens on April the 30th? Because we're not paying anyone, but it's the end of the month. So we need to record an adjusting entry. We have actually incurred another half month of salaries, but we haven't paid it yet. We're not going to pay it until May the 15th. So we have to show that liability on the books. So on April the 30th, we have incurred another half month of expense. Even though we haven't paid it, we've still incurred it. Again, think back to accrual accounting. So we would debit salary expense for $900, but in this instance, we're not paying it right now. We owe it, so we have to credit salary payable for that $900. Now let's think about what would happen on May the 15th. So May the 15th, we're now paying a full month's salary to this employee. We've already incurred half of it from April, and we recorded it as a liability, that half a month's salary. But now we're paying a full month's salary on May the 15th, so we know that we're going to credit cash for the full month of salary, which is $1,800. We've now incurred another half month of salary of $900, and we have a liability on the books from April the 30th that we no longer owe because we're now paying it. So we have what now is called a compound entry because we have two debits and one credit. So we would debit salary expense for $900 because we've incurred another half month salary from May the 1st through May the 15th. And we also no longer owe the second half of April's salary. So we're going to take that off the books with a debit to salary payable. And we're crediting cash for the entire amount. So we'll credit cash for the $1,800. So now let's look at the last two types of adjusting entries: accrued revenues and unearned revenues. Accrued revenues is a revenue that has been earned but has not yet been collected in cash. So let's say you earned $40,000 on account. Well, what would that look like? Well, we've earned it, but we haven't yet gotten paid. So someone owes us that money. So let's say this was on April the 30th. So we would journalize that with an accounts receivable. Someone owes us money. That's typically what we call accounts receivable. And we've earned it, but again, haven't gotten paid, but we've still earned it. This again is accrual accounting. We record revenues when they're earned, not necessarily when cash is received. In this case, cash hasn't been received. We don't know when we'll get it. We would record the cash once we receive it, but until we do, we still have to record the revenue because we've earned it, and it's on account because we have not yet gotten the cash. The fifth type of adjusting entry is unearned revenues. This is when you've received cash before you've actually earned it. So this creates a liability to you. So let's say I paid you $1,800 on May 1st to mow my yard for the next 6 months. You have agreed to mow my yard the middle of each month, so around the 15th. So we need to journalize your May the 1st and May the 15th entries. So on May the 1st, I paid you $1,800. So you got $1,800 in cash, but you haven't done anything to earn it yet. So you owe me something. That's called an unearned revenue, and that's a liability account. So you got cash, so cash is increasing, so you would debit cash, and you would credit your unearned revenue account. So again, that's a liability. So now what would you journalize when you actually come and mow my yard on May the 15th, let's say? Well, first you have to figure out how much you're going to earn per month. So that $1,800 was for a full 6 months of yard mowing. So 1,800 divided by 6 months is $300 per month. So you're going to earn $300 per month for mowing my yard. So on May the 15th, you're going to journalize the earning of 1 month of that unearned revenue. Well, you no longer owe me that 1 month, that $300, so you've got to take it out of the liability account. So to reduce a liability, we would debit the liability account. So we're going to debit unearned revenue. And now you're going to earn 1 month of that $1,800. So $300 of that $1,800 you're going to actually earn on May the 15th. So you're going to credit that service revenue account. So this would be the journal entry. You would debit unearned revenue for $300, credit service revenue for $300. Thank you for watching the video. If you enjoyed it or got something out of it, please give it a thumbs up. Also, please don't forget to subscribe to my YouTube channel, and then you would get notified when I upload new videos. Also, don't forget to visit me on my website, www.theaccountingdoctor.com.